The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, Chief Market Strategist at NexPoint with your weekly market deep dive for August 23rd, 2021. Well, last week was a busy week for the markets with a lot of potentially important moves. If you look at our first page with commodities and the dollar, you can see the first of the dominoes we've been watching, or potential dominoes, I should say. Specifically, the US dollar traded above 93 for this first time in several months. And this is a potential breakout on the charts. Remember, a strong dollar means weak commodities, and it's really important which way this dollar goes from here. Many technicians like to see 2 consecutive closes above resistance to call it a breakout, and I really equate support and resistance to fences that can be leaned upon, and I would not call this a decisive breakout yet in the dollar. That being said, you can see economically sensitive commodities such as copper and crude oil, crude in the top right, copper in the bottom center, both closed below their 20-week moving averages for the first time in several weeks. Again, these look like pullbacks in uptrends, so we're not ready to throw in the towel yet on commodities in general. Natural gas is also holding above its breakout level, and even lesser known commodities such as corn and coffee have seen long-term trend changes and are consolidating those gains here. So again, a potential breakout in the dollar that would change these charts, but no change yet. Looking a little more deeply at oil and gold, oil does a good job of describing what we're talking about. If you look at the 1 and 12-month forward contracts on Brent, you can see that they've fallen off their recent highs in the 70 to 80 area. This is an area where we found resistance in 2018, so it's very natural to find resistance on the chart in this area as well, or the market finding an excuse to consolidate or correct. That being said, as long as prices hold this horizontal gray dashed line, we can assume or state that they're still in an uptrend. Should that line be violated, however, it would be more meaningful damage to the chart and put that uptrend in question. As for gold, the jury is still out on gold. Gold should do well in times of rampant inflation and geopolitical instability. And you can argue we've got the geopolitical instability and the potential to print a lot of money in the US. That being said, gold still has yet to move or really move one way or the other. And the difference in spreads between the US 5-year less the 5-year break or 5-year break even less the 5-year yield and the 10-year break even less the 10-year yield actually have a bit of a divergence there and suggest a headwind for gold. Looking a little more in depth at yields globally, I'd like to first look at the US yield curve on the bottom left. You can see the yield curve is roughly where it was 6 months ago. The solid green line is the current status as of Friday of the US yield curve, and the dashed green line is where it was 6 months ago, the dashed gray line a year ago. So you can see we're roughly in the same place we were 6 months ago, and actually 6 months ago was a little bit steeper, meaning higher on the long end and lower on the short end. But again, those are fine points. The yield curve had been at a higher level, but obviously it's these pullbacks on the right side that you can see that have caused that yield curve to flatten slightly. Yields around the globe were lower last week, and the real concerning one was the 10-year US break-even, which was down 12 basis points. This break-even yield was a leader during the lows or the rally off the COVID lows, and to see more meaningful weakness here would be a concern going forward. Looking at just rates in the US, it was very much an inconclusive week. You can see per the daily chart on the top that we remain below the trend channel we had been seeing throughout most of 2021, but yet still above these gaps on the charts where we had those exhaustion gaps and those extremes. So again, an inconclusive week, but we would like to see the 10-year Treasury claw back above this 130 to 140 area. You can see just how important it is on this monthly chart to the left and the weekly chart to the bottom right. Both show that 140 area and how important it is. If we can get back above it, we would be in more of a normal market where commodities and interest rates are trending together and suggesting growth is out there in the world. However, if we see yields weak and commodities strong, that suggests a potential stagflation scenario, which we're really hoping not to see. Credit spreads also saw some very interesting and potentially important developments last week in that they widened, but they widened to the point where the indicator across the bottom, which is the ADX or DMI indicator, actually had a cross in the green and red line. That suggests a potential bottom or a potential cyclical or meaningful bottom in spreads, which we do need to watch closely. This indicator can go back and forth or whipsaw, as you see back here in 2015 and 2018 and 19. But should that buy signal hold, it would suggest yields, or I'm sorry, credit spreads are widening, which could be a very important headwind for stocks. Looking a little more at stocks, I'd like to start with the value line slide. And you can see at the top center that the value line was down 2.43% on the week. That being said, it's still in a relatively tight range. And you can see the market really has been consolidating its recent gains off those COVID lows in a very orderly fashion. The RSI has pulled back to 55, and even the percentage of stocks in the value line above their 200-day average is now under 60%. And think about that. That means that the constituents in this index, or 42 to 43% of them, are already trading below this purple line. That purple line is the 200-day moving average of the value line. And again, over 40% of the constituents are already trading under that line. So we believe we are in a market that has been seeing an ongoing correction for several months. And again, one that remains to be seen whether it will be worsen or not. Looking at stocks, we are seeing some weakening market internals. If you look at the left side, you can see the S&P 500 and the NASDAQ and market internals below them. What was very notable last week were that we saw 4 Hindenburgs flash on the NYSE. That is an indicator with a very ominous name, but one which typically occurs ahead of market crashes. Now, that being said, every time you see Hindenburgs, you don't see a market crash, but they usually are present. And it certainly indicates when the market internals are weakening and we're seeing a split tape. The specific conditions are you need to be above you need to have a rising 50-day moving average. You need to see weak breadth, and you can see from the advanced decline line here going sideways that breadth is much weaker than the trend in the S&P. And you also need to see a split tape, and that's one where you're seeing an equal number of new highs and new lows. So that's why these Hindenburgs are starting to flash. And again, we had 4 of them last week. You can also see weak market internals on the NASDAQ. And even though the NASDAQ was up on Friday, we had nearly 200 more new 52-week lows on the NASDAQ than new 52-week highs. So again, just the shape of this advanced decline line and the number of new 52-week lows suggests that we're in a market that has been seeing a correction underneath the surface. The question now being, does it worsen, or are the markets about ready to turn? If you look at the weekly charts, you can see the weakening internals on both the NYSE and even more so on the NASDAQ. But again, looking at the stocks above their 50-day average, it is down in this 30 to 40% area where it often turns. It is also at 29% on the NASDAQ where it sometimes turns. So again, it remains to be seen whether this rolling correction worsens or not. But if the bears are going to hurt the indices, this is the spot they can do it from. Looking at market sectors, you can see what a defensive week it was, meaning defensive sectors did the best. The blue arrows on the left show the utilities, healthcare, and consumer staples sectors, which were all green on the week. The only other green sector was technology, and that's largely due to people hiding in the fangs, meaning Facebook, Amazon, Netflix, Google, Microsoft, Apple, stocks like that they go to when times are a little bit dicier. What was interesting is you can also see The NASDAQ composite up 1.2% on Friday, yet the utilities just as strong. So again, a very defensive tone to the week. While the week was defensive, if you look at these sectors across the grid on the right, you can see all except for one remain above their 200-day or 40-week moving averages. And that one that is finally seeing some actual damage to the chart is the energy sector here on the right-hand side, third from the top. You can see the energy sector is actually breaking some support and below its 200-day or 40-week moving average. So of all the sectors out there, energy is the weakest, and again, one we think may be ripe for a pullback or a further decline here. Looking at the volatility surfaces, there was very little change in the surfaces last week. If you look at Friday the 13th compared to Friday the 20th, the only real difference is this corner in the back left, or you can see the difference in those two on the chart on the right here. That means people were more aggressive at selling near dated puts, which is interesting because you'd think with the market a little bit weak, they would be bidding those up, but very little change to the volatility surface last week. Looking at the sectors, however, you are seeing that increasingly defensive tone we were talking about. The green line is skew for puts or skew for calls or up volume. The red is skew for puts. And you can see that the bullishness in the Russell is waning as it is the NASDAQ. So both the Russell and NASDAQ are seeing the green lines lower and the red lines higher, which is a less bullish configuration than several weeks ago. That less bullish configuration is also being echoed in the semis and also the oil and gas industries. And you can see again, the green lines weakening, not crossing yet, and the red lines starting to perk up. Where they are crossing, however, is in gold. And again, you can see put skew increasing and call skew decreasing, which means there's actually a bit of a negative character to the market on gold. We mentioned earlier that gold usually does well during geopolitical instability and as well as massive amounts of money printing by governments, and yet we're still seeing gold fail to respond here. Looking at the overseas markets, it was another one where they were weak really across the board, particularly in the developed markets. Going down the center pane, you can see the DAX actually pulled back after its breakout. And even the EWQ and EWU, which represents the ETFs on France and Britain, respectively, pulled back off potential double top areas or areas where they had resistance in the past. So again, not devastating or damaging weeks, more pullbacks within uptrends, which is a very, again, healthy consolidation type market. Where the market doesn't look quite as healthy is in China. And if you look at the Chinese ETFs on the top right of the MCHI and the A shares, you can see those areas have broken some areas of support that were important. And they also have broken their 40-week moving averages. So again, the only markets really at risk here or at risk of bringing others down are those in China, although I hesitate to bet against the Chinese government when they want to prop their markets up. Finally, looking at our weekly COVID tracker that we find from First Trust, there was some optimistic news on the COVID front. First, looking at block A on the top left, you can see the 7-day average of new COVID cases in the US actually ticked down last week, which is hopefully a trend which will continue. And even though the number of cases exceeded the March-April peak, the number of deaths due to COVID, or the 7-day average, did not exceed that peak, which was, of course, good news. If you look at block B, there was an analysis of enrollment of school children for 2020 that showed there was a significant decrease in enrollment, particularly in the kindergarten age group. Looking at C, that is a chart that tracks ICU bed capacity. The blue part of the chart shows ICU beds occupied by non-COVID patients, the yellow by COVID patients, and the orange that are beds that are still available. While COVID cases are certainly starting to occupy more and more beds over the last 4 and 5 weeks, it's good news that the number of beds still available exceeds that occupied by COVID patients. when looking at those hospitalized by COVID by age group, you can see that the younger kids or those below 45 are starting to increase in the percentage. I think it's more important to note that this chart takes the shape of 3 lower highs, meaning the spike in hospitalizations now is less than that in March, April, which was less than around the turn of the year. Compare that to the first chart we looked at on the top left, which takes more of the shape of a W, meaning a peak, a middle, and a higher high in cases, more than we saw in March and April. So while the number of cases has exceeded the March-April peak, the number of total hospitalizations hasn't. This argues that the Delta variant, while more transmissible, is less deadly, or at least fewer people are going in the hospital because of it. Finally, the bottom chart does show that vaccine effectiveness does appear to be waning, which is why we're seeing so many headlines about booster shots. In summary, then, it was a very interesting week for the markets and a potentially important one with some potential breakouts that could change the scene pretty dramatically. The first was in the US dollar. And again, looking at the dollar chart on the top left, should the dollar hold above this 93 area, you could see it would be very easy for the dollar to get back up to the 98 to 100 area. And that could put a pretty big wind in the face of commodities. We're not seeing it yet. Commodities such as copper, natural gas look to be turning the corner and look to be in cyclical bull markets. The 10-year treasury remains below the key 140 area. It's something we hope that changes in the weeks ahead. And so far, credit, while it's been strong, is, I would say, neutral. We did see a signal in the DMI model on investment grade credit, and hopefully that reverses as well next week. That backdrop has led to an increase in unease in stocks, as evidenced by the trading of market internals, meaning the market indices are going higher, but fewer and fewer stocks are following the path of the generals. The advanced decline line has gone flat. The number of new 52-week lows is starting to match new 52-week highs. And those types of situations are typically where markets can see additional corrections. Hopefully the weekly charts are just about sold out and into areas where we will find support. But again, if the bears are going to move the indices, this is where they're going to have their chance. I'm Mike Hurley. This has been our weekly market deep dive for August 23rd. Thanks for spending your time with us. We hope to see you again next week.